In a break from what has been the norm, the Kenya shilling has recorded gains against major international peers for a second consecutive trading day. The shilling strengthened 0.95% to 100 shillings 53 cents on the back of the positive investment sentiment generated by the upcoming U.S. presidential visit. But analysts are raising questions on whether the rally was worth the pain that came with it. Adil Changole has more.
2015 has been a bad year for the Kenya shilling after coming under attack from a rebounding dollar. The U.S. currency has been gaining momentum over the last 1 year as the quantitative easing process began bearing fruits. However, while the dollar was doing well, most of the currencies around the world were feeling the heat.
Ghana cedi down more than 20%. The Tanzania shilling, the rand is weak.
The shilling was no exception, shedding a cumulative 12% from the beginning of the year and forcing the central bank to effect 2 increases to the central bank rate in the last 2 months. The central bank has also been aggressively mopping up liquidity in the market through its open market operations. And it would seem the measures are finally bearing fruits after the shilling rallied for the second day running to close the day at 101.49 to $1 compared to Tuesday's close of 102.55. Traders, however, say the rally has been driven by a scarcity brought about by the frequent intervention by the central bank. The result has fueled scarcity of the shilling, with the interbank rate rising to the highest level seen this year. In the last 2 weeks, the interbank rate, which is the rate at which banks lend to each other and acts as a signal for the level of money in circulation, has risen from 8.5% to the current 15.8%. Analysts also say the shilling has gained from the positive investment sentiment and the feel-good effect generated by the upcoming U.S. presidential visit. The local unit posted gains worth 1.52% against the sterling pound and 1.07% against the euro. Despite the rally, analysts are questioning the persistent interventions, which has seen the country's import cover fall from 4.64 months in January to 4.2 months in July. They say the local unit has performed relatively better than its peers, which have displayed significantly steeper declines against the dollar in the last 5 months.
Shilling has fallen dramatically against the dollar, but we've risen against our trading partners like the Uganda shilling. We've actually gone up 10%. Tanzania, a similar story. The shilling has actually been relatively strong in what has been largely a sub-Saharan African bloodbath.
And they have a message to the central bank in the lead-up to the 3rd Monetary Policy Committee to be held in August.
Communicate to us Kenyans how far they're prepared to go to defend the shilling, if that is what they're doing, and what costs they're prepared for us to pay to defend the shilling. Was it worth making loans this expensive, raising the interbank rate, and all these other factors that we've done, making capital more expensive, just because we needed to artificially defend the shilling?
Adil Changole, KTN Business.